Oh, this is Jeff Selke of Selke Financial Group and JRS Wealth Management. I'm happy to present to you today an economic and market update for 2024. It's actually August, the end of August 2024, and most of this data is compiled from the first half of the year, and some of it will be current as well. But just want to let you know the purpose of this is to I want to give you an update on what's going on in the economy, the stock market, and what the future holds, and an update on the election and how that could affect your money. So that's my goal today to give you some ideas. Nothing that I'm telling you about today is specific market advice or investment advice. So just want to make sure I make you aware of that, and let's get started. This is meant for our clients and for friends of clients. So I hope you'll share this and hope it helps you, as well as our radio show listeners. We'll have this, here on our website where you can see it at any time. So let's go from there. This is just a little disclosure. I'm an investment advisor representative for JRS Wealth Management. We are a full service RIA, registered investment advisory firm. And that's just a little bit about us. A little bit about me, for those of you who maybe aren't aware, I've been helping people since 1998 plan for their future, their retirement, investing. I've been a fiduciary, a financial fiduciary since 2002, before it was popular. I'm the author of two books, Making Your Dream Retirement a Reality and Retire Today. And the idea behind Retire Today was just to give you a blueprint for, hey, here's the key decisions you're going to have to make in retirement. And let's make sure you make good decisions as far as investing, taxes, social security, pensions, everything that you have to think about, creating a retirement income stream. I've been ranked in the top 1% of financial advisors nationwide based on MDRT since 2005. I'm a chartered financial consultant that requires 9 college level courses and passing a test on each one. And I'm a radio show host every Saturday on KNRS in the uh, along the Wasatch Front, Salt Lake City area, from 2 to 3 p.m. every Saturday. Hope you tune in. Okay, let's get started. We're going to talk about market recap, what's happened the first half of the year. We're going to talk about the Fed's next move, what's happening to the economy. We're going to talk about the election and what we like and what we don't like. And I'm going to try to summarize that pretty quick here. So I've got a lot of information. Um, first half of the year and up till now, the stock market looks really good. The stock market has had a great year, is up over 15%, the S&P 500, the Dow a lot less than that, but still a great year for the stock market. Stocks are very high. Not so good for high quality fixed income, that's bonds. Bonds have done little to nothing this year. And that's because interest rates are fluctuating and just kind of a not great situation for bonds. Could be better for bonds going forward, potentially. We'll talk about that. Um, why S&P 500 earnings per share have been growing over the years, and that's really good. Now inflation has been here, which is not necessarily good for bonds. And so anyway, there's a lot going on. Good for stocks, maybe not so great for bonds, but that could change here soon. Technology is leading the stock market. We can see that information technology, communication services, think about anything technology that you do, it's in those two categories. And that's where all the growth has been. So all the growth pretty much in the stock market, most of it has been in technology. Um, Again, tech is leading the way. And here's something that is a little bit disturbing, is that there are 5 companies that make up about 30% of stock market returns. Think about that for a second. 5 companies make up about 30% of stock market returns. So those 5 companies are really moving the market, is what that's telling us. If they go up in a day, the market's going higher. If they go down, the market's going down. So that is something we haven't seen for a long time. It's not good per se because we're concentrating all of that stock market performance into 5 companies. And if we increase that to 7 to 10, it's even a higher percentage. I mean, it's probably 40% in the top 10. So there's just these huge monster companies that really are moving the market. So just be aware of that. The rest of the market is just doing okay, and some of it's down. And that's what this chart is trying to show you. The stock market is the blue, the S&P 500, that looks good for the year, but the rest of the market, if we take out those, top 5 companies or so, they're really, if we just go from growth to value, we can see that the rest of the market is not really growing. So technology is really where the growth has been. Um, Okay, so the dollar has been very strong. I know many of us are worried about the dollar weakening at some point, but right now it is strong against other currencies. And that hurts international stocks. So that hurts other countries because if the dollar's strong, then we're able to go buy goods cheaper in other countries, in Japan, in Europe, and things like that. And so that is bad for the international community, can be good for us. It depends on how you look at it, but that is affecting emerging markets and international stocks. They have not been performing well for several years now. Earnings and yields are pointing in the right direction. This is good. Earnings are up for the S&P 500 for stock market companies, so they're making money. Yields are on their way down a little bit, so that's good for companies. If yields go down, if interest rates go down, that will be good for stock market companies because they borrow, and if they can borrow for cheaper, then that's going to help them. Um, so, what is the Fed going to do? What's the Fed going to do next? They're meeting in a few weeks in September. And what's their next move? Well, it's been primarily about inflation. They've said inflation has been too high, too sticky, so they're not going to lower rates. But now they're hinting and saying that they're probably going to start lowering rates in September. And inflation has been really bad, as high as 9.2% according to the government. I would always say to add a few percent onto that whenever the government tells us something like that. But they say it's down to 3% now. And what that means is just the last year, the growth has been about 3% in inflation. It doesn't mean inflation has gone down. It doesn't mean costs have gone down or goods have gone down. You're still paying too much at the grocery store. You're still paying a lot more at restaurants, right? So everything, insurance, everything, rent, now interest rates, everything's higher. So inflation has not gone down. It's just the growth is slowing down. And that's good. And that's giving the Fed some breathing room because sticky inflation contributors are starting to cool. So that blue line there is talking about um, used cars and trucks. Actually, used cars and trucks is the brown line, and then rent. Rent is the blue line, and you can see that car prices have been going down, which is good for inflation, and rent is at least leveling off. So rent isn't just skyrocketing like it has the last few years. So that's good. Um, and the labor market is softening. What that means is unemployment is starting to rise. Companies are starting to announce layoffs, big layoffs. We've heard several big companies lay off 10,000, 15,000 people at a time. And as that happens and job openings are going down, that's going to hurt the market. That's going to hurt the economy. And that is going to give the Federal Reserve some breathing room again to lower interest rates. Slower economic growth. We're seeing that the economy is slowing significantly right now. We've had a lot of growth over the last few years, but the economy is slowing down. And again, that's going to allow the Federal Reserve to lower interest rates. The prediction right now in the bond market is that the Fed is going to lower interest rates potentially 3 times this year before the end of the year. And if they start lowering interest rates, that should spur economic growth. It helps companies because they can borrow for cheaper. So there's some good things. Now, the bad part of that is that means your savings at the bank, your money in CDs, you're going to start earning less in those accounts. So you're going to want to start looking for alternatives as rates go down. There are other options that can help you earn better returns, and you can call or email our office if you have any questions about that. Um, and to be honest, a recession should have hit by now. We've all the indicators are telling us that we should have been in a recession for the past year, but we haven't. Somehow the economy has grown, and that's great. But it is still a concern that we could enter a recession. So we'll just have to see, what happens next. Stress is building for consumers. This is credit card debt, and you can see how it's skyrocketed over the last 3 years. Credit card debt's now over $1 trillion. That's a lot. $1 trillion that people are paying 20% interest on their credit cards on average. So that's bad. That means what that's telling us, what I see by looking at that, it says people are living on their credit card debt now. So as credit card debt goes up, that means people are putting more and more on their credit cards because they can't afford basic goods like groceries and rent and insurance. And so they're putting more on their credit card, they're carrying a balance, and that's bad. So that is something that is not good that is happening right now. So where do we go from here? The question is, are we going to have a soft landing? Soft landing means maybe a mild recession. Things aren't going to be so bad, just the economy is going to slow down. Are we going to have a recession at all? Could it be a hard landing, meaning that means the economy sinks really quick, the stock market tanks and goes down, um, and we maybe even have deflation versus inflation, where goods start going down in value because people just don't have the money to buy as much goods because they're losing their jobs. So that's the question: is where do we go from here? What's going to happen next? We're going to talk about that. Just a quick preview on the election. Markets are higher right now for the year, and that usually is good for the incumbent party. At the same time, we have a unique situation where the incumbent president is not running for office anymore, but his vice president is. So whether or not that's going to help her, we'll see. But the stock market being up is usually a positive for the incumbent president. Why do stocks rise in election year? Usually that's because the government is spending lots of money. Usually the incumbent party, the party in power, wants to spend all sorts of money, and they want to do things that will help the economy, because if it looks good in that year, especially the last 6 months of the before the election, then usually that helps them get reelected. So that's what's happening right now. Our politicians are spending lots of money to try to help the economy not go into a recession. The state of the race is tied, but the Senate at least appears to lean Republican. Probably the presidential election is up for grabs. We'll have to see on election day who wins. All I can say is get out and vote for who you want to win, and let's see what happens. Hopefully, the rest of the nation votes, because people deserve to have a vote and vote for what they want to see. But it looks like Republicans most likely are going to take control of the Senate. The House is still up for grabs and could be go to either party. Wall Street actually likes gridlock. Gridlock is when the two powers neither has control and they butt heads. That's actually good for the stock market over the long term. If you look at this chart, the years when the market has performed the best has been years under a Democrat president or a Republican president, but where the Congress is split. That's when the stock market has done the best over this time period of, I think it says 1933 to 2022. So again, there's different time periods we could look at. There's many periods where a Democrat president and a Republican Congress did great together. For example, under Clinton. So it definitely, you can argue that the president doesn't matter, because really just a divided government is what matters. If government is divided and they can't do too much of a, they can't make too much of a mess of things, that's good. So that's kind of what Wall Street is rooting for. Something to think about for 2025. Historically, most recessions hit in the first year of a presidential cycle. So just think about that would be next year, 2025. Most recessions hit in the first year of a presidential cycle. So just be aware of that. Let me just, to sum up things, what do we like and what do we don't like about what's going on? There's a lot. We like that long-term inflation is cooling. We like that the Federal Reserve is going to be lowering interest rates, easing on their monetary policy. That's going to be good for the economy and for stocks. Um, History is on our side, following rate hikes again. The bull market still has legs, so there's still a reason companies are profitable. So there's lots of reasons for the stock market to continue to go higher. The labor market is in good shape, although it is cooling down. Some of the things we don't like: geopolitics, of course. Wars are not, I mean, they can be good economically for some people, and for some companies and industries, but really overall, they're not good. The uncertainty, we don't like that. Domestic politics, the election, that creates uncertainty, and the stock market generally does not like uncertainty. Economic growth is slowing, as I said. Leading indicators are telling us that they're flashing the caution sign for a recession. And again, unemployment is starting to go up. So there are both good and bad things happening right now. I just want you to know that this is a time to make sure you feel like you're invested in the right way. You could argue to take risk if you feel like we're going to have a mild recession and the Fed lowering interest rates. That's going to be good for the stock market. On the other hand, you can look at it in a way of, hey, the economy is slowing, unemployment starting to rise. Maybe that's a time to take caution. So, not trying to give you exact advice here. If you want personalized advice, please call my office and schedule a time to speak with me. Love to help you. Make sure you're making good economic decisions, good financial decisions, so that your money is growing and doing the right things for your financial future. Hope you enjoyed this presentation. Tried to keep it short and concise, and I'll talk to you soon. Have a wonderful day.